Let's come back. Next, we will have 4 interesting topics about interest rate, about inflation, about the term structure of interest rate, as well as the currency purchasing power, also said currency value. These are very interesting topics. Please pay more attention on this. First, let's look at interest rate and inflation. The question in this topic is, what is the relationship between interest rate and inflation? You can make a guess first. Usually we have 3 typical type of rates when we talk about interest rate. Usually, whenever we talk about interest rate, it is the nominal interest rate. And nominal interest rate is the interest rate you often see in the bank, in newspaper, in website. Or the nominal interest rate is the official or interest rate on paper. That's why we use the word nominal. And then we have an inflation rate. Inflation rate is the percentage of your money's purchasing power decreases, either on a year-on-year basis or a CHEN basis. Year-on-year basis, usually we say YOY, and CHEN basis, usually we say MOM. MOM means months over months. These are 2 measures for comparison. While real rate, usually you cannot read a real rate from newspaper or from a financial institution. The real rate is usually calculated, but it exists in real world. The real rate means if you ignore the inflation, what's your real return? Real return on investment. In reality, because of inflation, our return usually already contains inflation. So, literally means real rate is the nominal interest rate net of inflation. Net of inflation. So you may think, wow, probably real rate equals to nominal rate minus inflation. I must say, for some of the situations, yes, but for some other situations, probably no. Let's look into details. About the relationship of these 3 rates, we have a very famous Fisher effect, or called Fisher's law. The relationship is, here the uppercase R refers to nominal interest rate, and 1 plus R is your results of investment, or you save your money in the bank. You save 1 RMB in the bank, and after 1 year or 3 year or 5 year, what you have is 1 plus R. This is for 1 year, right? If for 2 years, it is 1 plus 2R, because bank use simple interest, most of the products. And the lowercase r represents for real rate, and H represents for inflation rate. In this way, the real rate you have for investment activities would be 1 plus uppercase R divided by 1 plus inflation rate minus 1. This is the real rate. By this, we can guess that usually it would be less than the nominal rate, right? Because H usually is bigger than 0. And we can expand this equation. 1 plus H plus R times H. If this term is pretty small, either inflation rate is pretty low or interest rate is pretty low, R times H, provided it is pretty small, we can simply ignore it. Then the equation will become this way. The left side still 1 plus the big R, and the right side becomes 1 plus H plus small r. And we eliminate 1 from both sides of the equation. Eventually, we have this one. So this is very close to our previous imagination. However, if the term R times H is big, we cannot use this one. We have to use the whole equation, like this. In this way, these equations are usually to calculate the real rate R. In most of the cases, real rate R equals to nominal rate minus inflation, provided R times H small, very small, ignorable. In other cases, it should be calculated this way. 1 plus big R divided by 1 plus H minus 1. Based on the Fisher effect, we can quickly calculate something. Let me show you the trend of inflation. In order to calculate the real R, or the currency purchasing power, we need to describe the inflation trend in advance. Let's look at this graph. This graph is pretty interesting. Now, before we can understand the graph, we have to know how to describe inflation. How to describe inflation? We usually have two measurements. First is called CPI. Another is called PPI. CPI stands for Consumer Price Index, and PPI stands for Producers Price Index. CPI looks inflation from consumer perspective. While PPI looks inflation from producer perspective. Differently, producers includes companies, manufacturers, factories, and so on. And consumer perspective usually our individuals. And they focus on the cost of make a living. The cost of making a living. So it will focus on food and some of the necessaries in our individual lives. This time, we use CPI to make a comparison between China and Japan. And this blue solid lines refers to China, and this one refers to Japan. We use a special measure now. You can learn this measure. This measure is very useful. This measure is called a benchmark measure. Benchmark measure. A benchmark measure, usually we set a point of date as a benchmark. A point of date as a benchmark point. Then all the other observations in the sample compare to the benchmark point. In this way, we can put two things originally not comparable to each other become comparable to each other. Let's look at the CPI benchmark measure here. In this graph, we set the benchmark date as 2010. We set the benchmark value as 100, both for China and Japan. The CPI as 100. Actually, their CPI are different. However, in order to compare, we set both countries' CPI starting point as 100. In this way, we are easier to compare their trend. We are easier to compare. Just like this graph. Suppose the CPI of China and the CPI of Japan are all 100 at 2010 as a benchmark. Please be aware, 100 is not the actual CPI, but just for comparison, we set a benchmark value. By this method, we can easily find out the curve for China's CPI. It's like this. It's sometimes even higher here. It's in 2020. And this is the curve for Japan. And here we have the dot line as the benchmark line. This is the benchmark line. From this graph, we can clearly tell that compared to Japan, China's CPI is growing upward steadily. It's higher than that of Japan. While for Japan's CPI, before 2019, it's around the benchmark line. That means there is almost no inflation. And after 2014, there was some inflation in Japan as well, but pretty low. It's lower than 5%. Here is 105. That means it's lower than 5%. And after this point, means 2018, it's around this. So it's still very low. It's still very low. And then we can have a quick calculations based on these curves for YOY and MOM. Now let's calculate China first. This is the period for the calculation. It's from January 2010 to April 2022. We don't have the data to July. The newest data for us we can get from internet is April this year. The MOM growth rate is 0.1961. However, for YOY growth rate is 2.3785. YOY growth also means annual growth. Annual growth, right? That means China's currency, RMB, is losing its value, is losing its purchasing power at an annual speed of 2.3785. For example, suppose this year we have 100 RMB. If the inflation continues next year, the real value of 100 RMB this year will just as 97.6215. That means our currency, if we hold cash assets, the value of our cash asset is decreasing. Is decreasing. This is the effect of inflation. This is the effect of inflation. So in this way, just because of the effect of inflation, we have to manage our wealth. Now, there is a very popular job called wealth management. The primary purpose of wealth management is to keep or maintain the value of our assets. Say, for example, this year we have 100 RMB. We expect its purchasing power or its market value next year at least still remains 100 RMB, bigger than, equal or bigger than, right? So this is the primary purpose or objectives of wealth management. Of course, for some of the investors, they expect to employ wealth management to make their assets increased. make the value of their assets increased in an upward trend rather than the downward trend, right? So this is the inflation effect. Let's look at Japan again. Its annual growth is 0.5466. That means the Japanese yen could maintain its value better than that of RMB. Let me explain constant CPI. Constant CPI is an economic concept. It means we use a more steady way to calculate CPI. Yeah. We calculate the value of currency based on a benchmark year. Now let's look at the Python script on how do we draw the trend of CPI. This is the Python command here. You can update here, the date here to 2022, July the 14th. But actually we can only fetch the data until 2022 April. We don't have the data after April. Now let's do it together. And then we can extend the case study to other countries, such as India. It will be interesting. So let's do it together. First, let's copy this command. Let's change here to 2022, July 14th, or even 15th, it doesn't matter. Since I know the newest data we can get from internet is just till the April of this year. Let's run it. Oh, we have a problem saying EOL while scanning string. This means we are using a Chinese punctuations, and it already indicates where it's here, right? It's a Chinese punctuations. Then let's change it to English punctuations. We just copy the English punctuations here. Okay, then let's check again whether this time it worked or not. Okay, this time it worked. Now, this is the picture we have just seen on slides. It's China over Japan. Next, I expect to compare China with India. We know that the currency in India is called India rupees. Let's compare Chinese RMB with India rupees. I change the variable name here as India here. From 2010 to 2022. Let's look at the situations. Because China and India are the two with most populations in the world. Okay, this is the picture of the comparison on CPI between China and India. So let's explain. The blue solid lines refers to China, and this is for India. So from this graph, we can simply tell that the CPI in India is much higher than that of China, and the spread is become larger and larger. The spread is become larger and larger. That means the inflation situation in India is much more serious than that of China. And then we can also compare China with other countries, such as USA. Here, let's change to US. And here we change to USA. So before we have the results, we can make a quick guess on the results. Which one has higher inflation situation, China or USA? Well, this is the situation. So let's look at the curve. The blue solid lines refer to China, and this for USA. Now we have the same starting points. So this is the advantage of benchmark measure, but sometimes it often causes confusions for us. Actually, even at the starting point, the CPI in China and US are different. However, in order to make the CPIs of China and US comparable to each other, we set the same benchmark values at the beginning to 100. And then we can observe the trend of these two curves. And this method is pretty convenient for comparisons. From these two curves, we can find out for most of the situations, most of the time from 2010 to 2022, the CPI inflation situation in US is not that much as that of China. However, starting from 2022, the inflation situation of China and US, the growth rate, is roughly close to each other. And from here, we can tell that the inflation situation of US might be more serious now than that of China. And the fact tells us is, yes, from internet, you can easily find out that the inflation rate in US is now bigger than 9%, probably 9.1 or 9.2%. It's much higher than that of China. So you can easily compare the trend of the CPIs between different countries. That is pretty useful when you study the microeconomy. And after you observe the trend of the inflations, I believe you can guess that the central bank in USA, it means the Federal Reserve Bank, most likely will have new actions. That means they will escalate interest rate in order to fight against inflation. Once you have this forecast, you can quickly think that the market interest rate in USA would be higher. And then the interest rate is higher, the bond price will be lower. So if you are a bond investor, simply by these curves, you can have a quick forecast on bond price. In general, bond price will get lower, will gradually behave like a downward trend. Not now, but gradually. In this way, what are your advices to your customers in terms of bond investment? You will tell your judgment on the bond price trend to your customers, bond investors, and tell them be very careful to buy bonds. And if possible, probably it's a good time to sell the bonds you have. So that's why whenever we talk about bonds, we discuss interest rate, we discuss inflations. They are closely tied together. Okay, I think we have done the exercise together. There is another topic which is closely related to inflation, the currency purchasing power. So sometimes we also call the currency purchasing power as the currency value. The currency value means the market value of cash assets. For example, This year you have 100 RMB. Its market value is 100 RMB. And if you hold this 100 RMB to next year, your nominal value of your cash assets is still 100 RMB, but your market values of 100 RMB probably already down to what? 97 something. So this is because of the inflation effect. That means if you do nothing in wealth management, your wealth values, the values of your cash assets are actually decreasing. This means the currency purchasing power is decreasing, right? Now, let's discuss the currency purchasing power. Our question in this topic is, how does inflation ruin the currency purchasing power? We still use comparison and curves to demonstrate that. This time we use another interesting benchmark measure. Please pay attention to this, otherwise it's difficult to understand. Okay, so this graph is a demonstration about the currency purchasing power between China RMB and Japan yen. The currency is called yen. Okay, the symbols for RMB is this way, and for yen it's this way. This is yen. Okay? And the blue solid line here refers to China RMB, and the orange dot line refers to Japanese yen, JPY. From this graph, we see that if we set the currency value on 2015 as benchmark 100, okay, the same dollar amounts of RMB cash assets back to 2010, its market value is around 115. If moved to the year 2020, its market value would be down to less than 90. So this is because of the inflation effect. And what's the ratio for the money value down, for currency value down? Let's do a quick calculations. This is the period for the calculation. From January 2010 to January 2021, actually the end of 2020, and RMB is losing its value at an annual rate of 2.4092. Okay, if we extend the ending date to 2022 April, the rate may be different. And in the meantime, Japanese yen, it's only at an annual speed of 0.4543 in a much slower pace. Okay. This is the situation. Okay, we can update the situation to the most recent date when we have the data. Before we do the case updates, okay, we can have a simple equation to convert CPI to purchasing power, currency purchasing power. We use CPP to represent for currency purchasing power, and we still use CPI to proxy inflation, or as the proxy of inflation rate. Of course, we can also use PPI as well. So this is just roughly, because real CPP may have a more complicated algorithm. For simple calculations, we can calculate CPP, which is YOY this year, roughly equals to 1 divided by 1 plus CPI YOY. Okay. YOY here refers to year on year or year over year. Okay. In this way, we can demonstrate the curve, the trend of CPP in this way. Okay. Now let's look at the Python script. The Python script here, we use currency value. And previously we used CPI, right? We use constant CPI. Now let's do the exercise together and see the situations if we extend the case to most recent days. Okay, we extend to 2022, July 14th. Today should be 15th. Okay. There is an error message from Python command. Now let's see what is the error here. Okay. We're using a Chinese punctuation again. Well, there is strange. The Python command in our slides also copied from Jupyter Notebook. But when we copy back to Jupyter Notebook, some of the English punctuations change to Chinese punctuations. I believe this is a bug in Microsoft PowerPoint. Now it doesn't matter. Now we know this kind of bug, and it's not difficult for us to modify that. We use English punctuations to replace the Chinese punctuations like this way. Just make a copy and paste. Let's do it again. Okay, this is the most recent situations for currency values between China and Japan. And the blue solid lines refers to China RMB, and this refers to Japanese yen. So from this graph, we can tell that RMB is losing its values at a faster speed, right? A faster speed. Means the downward trend is more steep. It's more steep compared to that of Japanese yen. While for Japanese yen, also losing its value, but at a very slow speed. Then we can use the similar methods to compare with China and India, or with China and US, between RMB and US dollars. Let's compare with India. All the others are the same. Let's look at the situation between RMB and Indian rupees. Although RMB has been losing its values at a faster speed than that of Japanese yen, however, compared to Indian rupees, this is Indian rupees. This is China RMB. Compared to Indian rupees, we find that Indian rupees has been losing its currency values at a much faster speed compared to China. That means the slope of Indian rupees curve is more steep than that of China RMB. That means you can guess that the inflation situation in India must be more serious than that of China, while the inflation situation in China is more serious than that of Japan. That means in terms of inflation situation, India is more serious than China. China is more serious than Japan. Okay, so this is the sequence, an interesting sequence, right? Yeah, it's pretty interesting. In this way, we can compare with US dollar as well. Let's do it now. Let's compare with US dollars. This way. The star here means this command is being executed by Python. If this star disappears, we have a problem here. Okay, connection to data source failed. means there were some problems in my internet connections. And we have this data from these data sources. They are OECD, IMF, World Bank, and FRED. We have known these. FRED means Federal Reserve Economic Data Center. And World Bank means, WB means World Bank, and IMF means International Monetary Fund. OECD means Organizations of Economic Cooperation Development. Let's do it again. I wish this time it worked. Or if it still fails, then we have to do it again in another time. This is a good time, not a good time to do this work. Okay. Just now it still works, but this time it doesn't work. Okay, problem again. Probably we do it later. Okay, let's have a quick review on what we have learned today. In this session, we have entered a new module, Module 2. In Module 2, we focus on bond. Module 1, we focus on stock. In Module 2, we have learned some of the fundamental things about bond, such as bond's elements. And in order to further understand bond, we have to understand some of the related factors, some of the critical factors to bond. They are interest rate, and inflation is related to interest rate. So we have studied some of the inflation situations. We compare the inflation situations, and the currency value or the currency purchasing power is closely connected to inflation. So we also discussed the changes or the trend of currency purchasing power. Next session, we will talk about a very important concept, which is called term structure of interest rate. Okay, this part might be a little bit difficult for us to understand. Okay, I hope you can pay more attention on this part. And in this part, if you can understand this part, you will have a further understanding about the trend of microeconomy. That's all for today. Thank you very much.